Most Americans earn somewhere between $50,000 and $60,000 a year. But what if a single investment, just $100,000, could pay you more than that every single month? In this video, I put two powerhouse ETFs, SCHD and JEPI, in the ring to see which one can realistically outperform a full-time job. How they work, what they're made of, and how they actually behave over time. We'll look at performance, risk, income strategies, and in the end, I'll show you and Josh how one of these ETFs could turn a $100,000 investment into a portfolio worth over $6 million, paying more than $50,000 a month in dividend income. But first, let's meet the contenders. We've got SCHD and JEPI, and while those names sound like something out of a finance textbook, they're actually two real, pretty easy to access funds that a lot of people are using to build wealth in completely different ways. SCHD, or the Schwab US Dividend Equity ETF, launched in 2011. It focuses on US companies with strong histories of paying and increasing dividends. These are companies with recognizable brands, steady profits, and solid financials. SCHD is often regarded as a buy and hold ETF for long-term investors who prioritize consistency and long-term growth. Now, JEPI is a bit different. It's the newer kid on the block, launched in 2020, and officially it's called the JP Morgan Equity Premium Income ETF. Unlike SCHD, JEPI is not just sitting back and collecting dividends. It takes things a step further by using something called a covered call strategy. Basically, it's squeezing extra income out of the stocks it already owns by selling options. That might sound technical, but all it really means is JEPI is doing some financial judo to generate more monthly cash flow, which makes it super appealing for anyone looking to get paid now, not just later. Of course, there's a trade-off. JEPI's strategy involves more active management, which means it charges a higher fee, 0.35% compared to SCHD's 0.06%. In return, you get more income, but potentially less growth. Now, let's zoom out and bring this back to something real. The average full-time American earns somewhere between $60,000 and $70,000 a year, which is roughly $5,000 to $6,000 a month. So the big question here isn't which ETF is better, it's deeper than that. We're asking, if you had $100,000 and gave it time to grow, could one of these funds actually generate enough income to challenge or even replace a full-time salary? Now, before you judge a fund by its returns, you have to understand what's inside. Let's take a look at the holdings and diversification of SCHD and JEPI, because what these ETFs own can tell you a lot about how they behave, grow, and generate income. Starting with SCHD, this fund holds 103 stocks and leans heavily into established dividend-paying giants. Sector-wise, its portfolio is led by consumer defensive, 19.35%, and energy, 18.92%, followed by healthcare, technology, and industrials. You'll also find smaller allocations in consumer cyclical, financials, and communication. The remaining slivers, basic materials, utilities, and cash, make up less than 2% combined. SCHD's top 10 holdings account for 41.23% of the portfolio. That includes well-known names like Coca-Cola, Verizon, Cisco, Lockheed Martin, Home Depot, and Altria. These companies are dividend stalwarts, with steady cash flows and long histories of returning capital to shareholders. Now, over to JEPI, and this one takes a very different approach. It holds 127 stocks and includes a broader mix by sector. Its largest slice is technology, 20.49%, then industrials, financials, healthcare, and consumer cyclical. It also includes meaningful exposure to consumer defensive, communication, utilities, real estate, and energy, plus a small amount of basic materials. What's unique about JEPI is that it also holds corporate bonds, 12.87%, and cash, 1.11%, which helps support its income generation strategy. It's not just about dividends, it's also about riding options on the equities it owns to pull in more yield. JEPI's top 10 holdings only make up 16.06% of its portfolio, a sharp contrast to SCHD. And speaking of those top holdings, you'll recognize a lot of them. Visa, MasterCard, Meta, Microsoft, Amazon, Nvidia. This is a who's who of tech and growth companies. Their different sector bets and concentration levels directly impact how they behave, and that's key to understanding which one fits your investing goals. Now let's talk results. You've seen what SCHD and JEPI are made of, now it's time to see how they've performed, because at the end of the day, structure is one thing, but how a fund behaves in real markets is where the story gets interesting. Starting with SCHD, this fund has a strong long-term track record. Over the past 10 years, SCHD has returned a solid 102.01%. That's more than doubling your money, and it's done that with a calm, consistent approach. Over the last 5 years, it's up 43.33%, and even in the past 12 months, it's managed a 2.78% gain despite market volatility. Now, compare that to JEPI. Since JEPI only launched in 2020, we don't have a 10-year window. But in the 5 years that we have, it's delivered plus 9.79%, and in the past year, it's slightly down at negative 1.02%. That's not bad for a high-income ETF, but it's a very different growth profile from SCHD. In a couple of minutes, I'll show you and Josh how one of these ETFs could turn a $100,000 investment into a portfolio worth over $6 million, paying more than $50,000 a month in dividend income. Back to the topic, what this performance tells us. SCHD has outperformed JEPI in terms of capital appreciation. It's had time to prove itself, and it's shown that over long stretches. It can generate real wealth through a mix of dividends and stock price growth. But performance isn't just about returns, it's also about risk and how much volatility you experience along the way. SCHD has a standard deviation of 14.65, which is slightly higher than the average equity ETF. That means it has a bit more price movement, especially during rough patches. Its annualized volatility is 16.26%, which adds some swing to your portfolio. It's also more concentrated, so poor performance in a few top holdings can be felt more heavily. JEPI, on the other hand, is built to smooth out those bumps, mainly using a covered call strategy. Its standard deviation is just 9.52, which is notably low. Its annualized volatility clocks in at 13.75%, which makes it more appealing for investors who can't stomach sharp price dips. And because JEPI's top 10 holdings only make up 16.06% of its portfolio, it's much less exposed to individual stock performance. So what about the technical side of things? You know, the signals that traders and analysts watch to get a sense of where a fund might be headed next. Right now, JEPI is rated neutral, but with a sell signal on its moving averages. That doesn't mean it's in trouble, it just reflects recent price softness. SCHD, meanwhile, is also rated neutral overall, but with a buy signal on technical indicators, suggesting moderate near-term strength. Bottom line is, SCHD brings stronger long-term growth, but with slightly more risk. JEPI offers stability and income, but gives up some upside. One is a compounder, the other is a cushion, and those trade-offs will matter, especially when you start projecting future income. But performance alone doesn't tell the full story. To really understand these ETFs and why they behave so differently, we need to look at how they're built to make money in the first place. Because yes, both of them aim to grow your wealth, but the paths they take couldn't be more different, and that difference is huge when you're thinking about what kind of ride you're signing up for. JEPI operates like a highly tuned engine that adjusts constantly to the road ahead. It's actively managed, meaning the team behind it is continuously making decisions about what to buy, hold, or adjust based on the market's mood. That gives it flexibility, a way to potentially cushion the ride when things get rough. But what sets JEPI apart is its strategy around income. So here's the core idea behind JEPI. Imagine you own a stock. You think it'll do okay, but instead of waiting around hoping it goes up, you want to make a little extra money from it right now. What JEPI does is something called a covered call strategy, and here's how it works in real-life terms. Think of it like this. JEPI is renting out the stocks it owns. Let's say JEPI owns shares of Microsoft. It can rent out those shares to other investors, specifically people who are betting that the price of Microsoft will go up soon. These people pay JEPI a fee, called a premium, for the right to buy Microsoft at a set price later. If Microsoft's price goes up a lot, those buyers can cash in, and JEPI misses out on some of that upside, but it still keeps the fee. If Microsoft doesn't move much, JEPI keeps the stock and the fee. That fee, that's extra income, and JEPI does this kind of thing across lots of its holdings every month. That's how it's able to generate such high, consistent payouts, even when the market is going nowhere. Now here's the catch. By agreeing to sell some of that potential upside in exchange for cash today, JEPI limits how much its investments can grow when stocks take off. So in booming markets, it might lag behind funds that don't use this strategy. But during flat or choppy markets, it holds up better because it's still collecting those premiums like clockwork. So in plain terms, JEPI trades a little bit of long-term growth potential in exchange for steady monthly income. That's the secret sauce. And for a lot of investors, especially those who want cash flow now rather than growth later, that trade-off is totally worth it. SCHD, by contrast, takes a much more hands-off, rules-based approach. It sticks to a very clear set of guidelines. Find high-quality companies with reliable business models and a track record of paying dividends. Then hold on to them. The idea is that if you invest in strong businesses and give them time, the results will follow. SCHD doesn't try to outsmart the market day by day. It plays the long game, leaning on consistency and discipline. That makes it a strong option for investors who don't want surprises and who believe in letting compounding and dividend growth do the heavy lifting. From a technical lens, the distinction is sharp. JEPI may appear more reactive, constantly adapting and moving with the flow. SCHD, meanwhile, reflects a more deliberate strategy, one that's less exposed to short-term movements and more focused on building value over time. JEPI's behavior might appeal to those who like more stability and regular payouts. SCHD may resonate more with those who value structure, long-term growth potential, and the benefits of strong fundamentals. Neither strategy is wrong, they just cater to different mindsets. One emphasizes tactical execution, the other is grounded in long-term resilience. Choosing between them isn't about which is smarter, it's about which one aligns better with how you think about risk, growth, and the role your investments play in your life. So with all that in mind, performance history, risk profile, and current signals, the next natural question is this: how do these funds actually stack up when we look ahead? Like, really look ahead, 10, 20, even 30 years down the road. What kind of future could a single investment in JEPI or SCHD actually buy you? Let's run some numbers and find out. Let's start with JEPI. This fund is all about income. Its current dividend yield is a whopping 8.34%, which means it's built to start paying you almost immediately. And while the share price doesn't move a whole lot, averaging just 1.77% growth per year, the magic really happens when you reinvest those dividends and let them start working for you too. Now, if you invest $100,000, here's how that would look. After just 1 year, your $100K turns into around $110,000. Not bad. Stick with it for 10 years, and you would be looking at a portfolio valued at $264,000. At the 20-year mark, you would be sitting on $706,000. And if you let it be invested for 30 years, that initial $100,000 would grow into a massive $1.9 million. Again, all without adding another penny. Also, after 30 years, your portfolio would be throwing off about $153,000 per year in dividends. That's over 13 grand every single month, which is more than enough to replace most full-time incomes in the US. Now compare with SCHD, a fund that takes a very different approach. Its dividend yield right now is around 3.96%, which is solid, but nowhere near JEPI's. The real magic, though, is what happens over time. This fund's dividend growth rate sits at 11.3%, which means not only are you getting paid, but your paycheck is growing every year. Add in an average annual share price growth of 7.26%, and now you've got a serious wealth-building machine. So let's plug in that same $100,000. After 1 year of SCHD, you'd be at about $111,000. Fast forward 10 years, and it will be valued around $311,000, already outpacing JEPI by nearly 50 grand. But the real fireworks happen after that. At the 20-year mark, SCHD crosses the $1 million line, sitting at around $1.18 million. And by year 30, your original $100,000 will be valued at over $6 million. And the income. This is where things go from impressive to life-changing. After 30 years, SCHD could be paying you $636,000 per year. That's more than $53,000 every single month. It's the kind of income that doesn't just replace your job, it replaces your lifestyle, your retirement plan, and probably a few of your neighbors as well. Let's call it like it is. By the numbers, SCHD is the clear winner over the long run, turning $100K into over $6 million in 30 years, with monthly income topping $53,000. Now, JEPI still holds its own. It's no slouch. Over that same 30-year period, it grows your $100K into $1.9 million and pays you 13 grand a month in income, which for a lot of people could absolutely replace a salary and give you real peace of mind. But it tops out earlier. Its strength is in those earlier years, not the final numbers. What really makes this comparison so interesting, and honestly so useful, is that it doesn't just come down to numbers. It comes down to timing. It's about what kind of financial life you're aiming for and when you want it to show up. JEPI comes out of the gate fast. If you're approaching retirement or you're just looking to start pulling in reliable monthly income right away, JEPI makes a ton of sense. It gives you that paycheck feeling without waiting decades. It's built to deliver now. It's front-loaded, steady, safe. You're not going to triple your investment overnight, but you will have money coming in like clockwork. SCHD though, it's for the patient ones. The people who say, I don't need it yet, but when I do, I want it to be massive. It takes time to build momentum, but when it finally hits stride, it takes off. The income grows, the value multiplies. It's not just a fund anymore, it becomes a full-on wealth machine. So if you're trying to figure out which one is better, you're asking the wrong question. It's not about being better, it's about fit. If you want income soon, like within the next few years, JEPI has your back. If you've got time on your side and you're willing to let compounding do its thing, SCHD can turn that same 100K into something truly life-changing. Want to start getting paid as soon as next week? Click the video on screen to see how a carefully selected 12-stock portfolio can pay you every single week.